presenter. I haven't seen you present, but
Okay.
I'm sure you're amazing as well.
Good afternoon, everyone. My name is Renee Crawford. I am the U.S. manager of Paul International Consultants. I will be doing some training today on your standard foreign national loan. And once we go through the programs and how that works under our company, Paul International Consultants, I'm also going to give you some information on our new exciting state-of-the-art new program and website that we just launched a few months ago, which will be an awesome outlet for not only foreign national clients, but also any investors purchasing homes in anywhere in the U.S. So, is there a clicker or?
There have two using also working controls.
Yeah. That side.
But then you have to go back.
That's okay. What do you do, up and down?
Yeah,
Okay, so I'm going to tell you a little bit about Paul International Consultants, what we do, what we offer, and then we'll go into a little bit of detail of what type of financing your clients can get, what they should typically look for, what type of documentation is required, and then I can take any questions that you have. So, Paul International Consultants is based on experience, our professionalism, and our knowledge. We've been doing strictly foreign national loans for about 22 years now. We don't do U.S. citizens through Paul International Consultants. It is only foreign national loans. So we do the consulting for over 20 years. We work independently from the lenders, builders, realtors. We work specifically for the clients. We have two offices, three offices. We have our main office here in the U.S. is in Fort Lauderdale. We have an office here in Cape Coral, and our main headquarters are based out of Frankfurt, Germany. Because we have several offices in different time zones, it allows us to be a little bit proactive with the clients, whether they're calling from China or Germany or South America. We have two different offices, two different time zones to be able to reach them more easily, because between China and here is 12 hours, and sometimes that could cause delays in your loan process if you keep having to wait 12 hours in order to contact your client. Having the office in Germany, there are only 6 hours difference, and so that helps a lot in the financing process. Paul International Consultants does offer services all through the U.S., not just Florida. And we have a portfolio of probably 100 different loan programs that can be offered to foreign national clients. We have multilingual staff. Our staff speaks 9 languages. That's our in-house staff. We do have contracted staff for additional languages, so we pretty much have everybody covered. So what can be financed? Foreign national loans are similar to your conventional Fannie Mae, Freddie Mac loans. The guidelines are a little bit different, but it depends on the client, the program, the house. It's not a set in stone kind of thing. Not every foreign national client is going to get the same program. So it's a lot of fitting the client into a box instead of the client fitting into a box, where you just have a credit score and income. It's a little different when it comes to foreign national loans. So what can be financed? Purchases of single families, townhomes, villas, condos. We typically can do rate and term and cash out refinances. We could do new construction as well as construction perm loans. We can offer blanket loans on income-producing properties as well as vacant land. Typically it's important to keep in mind that any type of foreign national programming is not going to close in 30 days. You got to at least have 40 to 60 days, if not 90 days, from contract to closing. So how much can my clients borrow? Foreign nationals are never going to get the 5%, 10% down mortgage. They typically are going to need somewhere between 30 to 50%, depending on their scenario. There are, for second homes, most programs will do 30% down, with the exception of cash outs is typically they'll only lend about 60% of the value of the property. We do have programs that will go up to 75% for the purchase on investment properties. However, the rates are typically higher, that most people end up putting the extra 5% down in order to get a lower rate. So how is the property value determined? The property value is determined based on either the purchase price or the appraised value, which is standard for the industry on a purchase. For new construction and construction loans, they're typically the cost of the land plus the cost to build, or the appraised value, whichever is less. For a renovation loan, they will look at the purchase price plus the contracts for renovation that they're looking to do, and then they will get an appraisal based on that, and then they will take that value and use that for the price. And on refinancing, typically it's based on market value based on the appraisal, unless the client has purchased it within the last 6 months. And then they typically use the purchase price.
On
Yes.
the new construction, the land plus building cost or appraisal, whichever is less.
Yes.
I mean, no builder's gonna sell the home for the cost.
Well, this is more for construction loans. When they're purchasing from a builder, it's really just considered a purchase loan.
Okay.
Okay, so now we have the intended use of the property, and this becomes a big deal that a lot of people don't realize what the differences are between second home and investment. It has come up a lot in the Miami-Dade area recently. A lot of banks are getting more stringent on guidelines because people are falsifying their intent of use of the property, which technically is mortgage fraud. So we try to be very careful in making sure that our clients understand the differences and get put in the right program for what their intent is for the property. Now, intent is their intent at the time of purchase. So keep that in mind. If I am a German and I'm coming here and I am purchasing an investment property, and 3 years from now I win a green card and I decide to move over here and then I want to live in my house, you can do things like that because intent can change. But at the time that I purchased the property, it was then my investment home because I was living in Germany. I didn't have a green card. So intent can change, but your intent at the time of purchase is what type of loan the client should get. So there's usually 3 categories when it comes to foreign national loans. You have your straightforward second home, that the client owns a home in their home country, they're buying a home here, they're only going to use it for personal use, not a vacation rental, not for anybody else to live in. It will be strictly their second home when they come to visit. Then you have your second home with occasional vacation rentals. This is, I would say, probably 70% of our clients fit into this category. They get 2 weeks, 3 weeks out of the year. They come to Southwest Florida, they stay in their home. But when they're not here, they have an agent who rents out their home. They do it by the week, by the month. Sometimes they rent it seasonally. The guideline that most lenders have is that the client themselves must use the property for at least 14 days out of the year. It doesn't really set any type of precedence outside those 14 days what it can be used for. So a lot of lenders will allow them to do vacation rentals as long as the client has control over the property and uses it for personal use on occasion. So somebody can't say that they're gonna rent it out and use it for personal use, but then sign a yearly lease. Because if they're signing a yearly lease, it doesn't give them the availability to use it as personal use. When you have somebody who is not going to use it for personal use and wants to rent it by the year, this is an investment home. And so those are the different categories that the clients can fall under. Depending on what category they fall under, depends on the loan program available. There are some programs that are strictly second homes. They won't allow occasional rentals, they won't allow yearly rentals. It has to be for personal use. Those programs generally will have a lower rate, but it's not that much lower than the other programs. So it's always something to keep in mind to make sure that the clients understand what their intended use is and to guide them accordingly for the type of loan that they're looking for. Okay, so how long is the loan term? So again, on foreign national loans, things vary a little bit per program. In general, most of the programs that we offer through Fall International Consultants are 30-year loans. We do have some that are 15 or 20 years. It depends on what the client is looking for and what they're wanting in an investment property or in a property that is going to generate some kind of income from them. If you have a client who is buying a property now, but has said, like, I know I'm only having this property for 3 years, or I'm gonna pay it off as quickly as possible, I don't really want a long-term loan, then ARMs are great programs for those clients. I would say probably 90% of our foreign national clients do not keep their loan more than 10 years. Most countries, it's pretty standard that you don't keep long-term loans. They don't have 20 different credit cards like we have here in the US, and they don't, mortgage everything in car loans. The mentality is a little bit different when you have people, for instance, from Germany. Like when they take out a home loan in Germany, they're taking out a loan, more of a short-term loan, and they pay it off when, as quickly as possible. So their mentality isn't really to keep a loan for 30 years. So most foreign national programs are 15, 20, or 30-year term. The advantages are that most of those programs give no prepayment penalty, so the clients can pay them as quickly as possible. And that the longer term gives them a lower payment. On no-doc loans, which we'll go over later, basically these are your shorter term loans. This is basically, here's my information, sign on the dotted line. There's no documentation required, no bank statements, no seasoning of funds. It is a true no-doc loan. And these are great for clients who maybe is trying to sell a house in another country but hasn't sold it yet and wants to, found the house that they love here. Those type of clients, even though the interest rate could be a little bit higher, in the long run, because they can pay it down and the interest adjusts based on what the actual payment is, it helps the client to pay it off quicker. So again, it depends on what the client's intended, what they intend to do with the property in the long term. So So most foreign national programs are adjustable rate mortgages. They're typically 3 years, 5 years, 7 years. We do have, I think, 2 programs that are 10 years. But the interest rates are typically higher. Most clients don't like that option. And then there are very few fixed rate programs for foreign nationals. Those interest rates are typically in the 7% range. Most clients don't go for that because they're not keeping the property long term. So the programs, the advantages of the programs with the ARMs are that the payments can adjust when a payment is made. So let's say your client has a 3-year ARM, it's the 4th year, they decide that they want to put, $100,000 towards their mortgage. When they put that money down and the loan changes based on the interest rate, they will adjust down to the new loan amount and not the original loan amount. But the disadvantages is that it has no long-term guarantee. So if they do a bit longer than the 3, 5, and 7 years and interest rates go up like they are, then they could have potentially higher payments. The fixed rate payment, if they do pay down part of their principal, the rate never changes. It just comes off of the back end, and their payment will still be the same no matter how much they pay down. And so, it doesn't always give that much of advantage to pay the higher interest rate to have a fixed rate loan. Okay, so how monthly payments work. Typically on foreign national loans, they're going to be paying principal, interest, taxes, and insurance. There are no programs that I am aware of that will allow you to waive escrows on foreign national loans. The reason for this is the protection of the lender. If somebody doesn't pay their insurance because they didn't get the bill while they're in Brazil, the house no longer has coverage, it catches fire, now the lender is out money, the borrower is out money. If they don't pay their taxes, county comes, puts a lien on the property, the lien then goes into first position, and the mortgage goes behind it. So really it's for the protection of the lender, which is why they collect the taxes and insurance on every file. This is just to give an example of what our standard program looks like. The purchase price $400,000, the loan amount at 65% of $260 with an interest rate of 4.99%. It gives you a principal and interest payment of about $1,395 with approximate property taxes and insurance. So you're looking at about a $2,100 payment. Okay, so I'm going to talk a little bit about construction loans. Construction loans are pretty popular here in Cape Coral. A lot of clients like to build their own property from the ground up. There's not a lot of banks that do construction loans in general, but there are some really great programs available for foreign national clients to be able to do this. So the financing application should be done before anybody starts anything. This is the biggest point, because if a client buys a lot, let's say they clear it, they start to put up a seawall, but then they don't finish because they have to use their money for something else. Now they want to come and get a loan, but they have this half-built seawall. It becomes an issue because you have a notice of commencement that's open. They have to make sure everybody gets paid, they have to close it out, they have to restart. It's going to delay their process. So if you do have a client that is purchasing a piece of land and wants to build on it, it's important to make sure that they understand if they want to get a loan for building, they really should not do anything to the property until they get their financing in place. Because otherwise, if they start something, if they start to build and have to go back, it's going to delay their process probably about 3 months. Because it takes that long for the title company to make sure that everything is closed out properly, everybody is paid, and then they can, you know, give clear title for them to move forward. So, the current land value is usually used as equity. So if you have a client who buys a lot for $40,000 and they pay cash, that $40,000 then ultimately goes as like a down payment. So it's less money that they have to come up with as their down payment to the loan in general. If a client doesn't own the lot and they want to put it as part of the property, they're welcome to do it all as one and then just pay a down payment like they would on any other house. The lender will still examine the credit worthiness, the history, references of the construction company. The builder must be approved by the bank. This is a really good advantage to clients who do not live here. You know, if you live here and you're building a house 4 miles from here, you can go every day, check on the status, see what's going on. When you have a foreign national client who lives halfway across the world, they're not getting regular updates as to the construction, but the construction company is building and they're taking money. And the only way to have it very secure for them that the builder's not getting additional draws unless that property is completed. So the lender makes sure that each builder is approved. They don't have, you know, outstanding liens against them. They don't have court cases. You know, the company is in pretty good standing. They're not like going bankrupt. They kind of do their due diligence to make sure that the bank is, the bank does their due diligence to make sure that the construction company is a good company, that the company is going to actually follow through, build the house, not take a draw and take off and run, which has happened in the past. So part of that process too is that the bank manages the draws. So once the builder says, okay, the first draw is to cover A, B, and C, the bank will not give them any money until the bank sends out an inspector on their behalf to make sure that A, B, and C is done, and it's done properly, and all permits have been filed accordingly. And once that happens, the bank will go to the client and say, yes, the builder did what they're supposed to do. Can we issue the next draw? And then the client signs off and the bank sends the money. So it really gives the client a good security that, you know, money is not just being paid to the builder and then the money runs out and the house isn't complete. So it's a good security for clients rather than paying cash for construction. And it gives them, it also gives them easy payments. Meaning, when you take out a loan, you're taking out a $200,000 loan, you start paying on that $200,000 loan. When you're doing a construction loan, the payments that you're making are only based on the draws that are given. So if you have a $200,000 loan, the initial draw on the house is $20,000. The client is only going to pay the interest based on that $20,000 until the next draw. When the next draw comes, if the next draw is $50,000, now they have a $70,000 loan. Now they're only paying the interest on that $70,000. And it goes like that until the home is complete. Once the home is complete, the loan then modifies into a full loan, the 3-year, the 5-year, the 7-year arm. The clients do not have to close again. It's a one-time closing up front. All they have to do is sign paperwork, and then they will take over with their regular principal, interest, taxes, and insurance. So, sure.
On the lot, if somebody buys a lot, do they have to keep that lot for a certain period of time before they can use it as a down payment?
No, but let's say somebody closes on a lot today for cash and they apply for a mortgage in a week from now, the lender may ask, in most cases, the lender will ask for them to show proof of where the funds came from in order to buy that lot. They want to make sure that it's personal funds. Now, if somebody's owned a lot for a couple years, they're not going to ask where that money comes from. So as long as they can source it, it's not a problem. So what documentation is required in order to do any foreign national loan? Well, foreign nationals don't have credit reports, and they don't typically have tax returns and W-2s like we have here. So each lender has very specific guidelines of what they will allow and what they won't. But in general, it's pretty similar. When you're talking credit, they don't have a credit report to look at, so they ask for credit reference letters. These letters basically are the same information that would show on our credit reports. It asks for the date the account was opened, how much money they owe, what their monthly payment is, and have they ever been late. And that's what the bank is looking for, is 3 letters with a 12 or a 24-month history, so they can kind of establish their own credit report in order to meet the credit requirement. A lot of times clients don't have multiple credit cards, or they don't have a mortgage, so a lot of times we have to get alternative credit, meaning if they pay like an HOA fee, or they pay a gym membership, a cell phone, things like that. Anything that they make monthly payments on consistently and have for the last 2 years are things that the lenders can use in order to build the credit. Sometimes clients can get a credit report from their home country, countries such as Mexico, UK, even Germany has its own credit reporting repository called a SHUPA. Sometimes the lenders will accept those and sometimes they won't. It all depends on the lender itself. For income is in a lot of cases easier than us here in the US because we have tax returns and W-2s and things like that. For most lenders, they will just take an accountant letter showing what their income is for the last 2 years and year to date. For employed borrowers, they just want a letter from their employer with the last 2 years and year to date, as well as a current pay stub. Now, there are lenders who do require personal and business tax returns. So depending on where the client falls in, if they actually have tax returns, if their country has tax returns like we have here, or if you have a self-employed person, like all of us in this room would know, is that you write off a lot of things on your tax returns. So when qualifying for a mortgage, it's really hard because you kind of fall in this, okay, well, do I not write off stuff so I can qualify for more? And you have this kind of back and forth balance. Clients like that who write off a lot of their income, we typically try and fit them in with one of the lenders that are not going to require tax returns because, they're not going to show as much income. Whereas if they just provide the CPA letter, the CPA letter is only going to want gross income after expenses but before taxes. So they're not going to go through the tax returns with a fine-tooth comb and make the income lower. So these are the things that we look for in the clients when we initially do the consultation to see how their income is derived, what documentation they can provide to make sure that they go to the bank with the best parameters to fit their needs. As far as assets, they provide bank statements just like we have, 60 days or 90 days. The bank statements are going to have to show enough cash to close plus some reserves. There is no set number of reserves, but if you have somebody in another country buying a $200,000 house here and they need $70,000 for closing and they have $72,000 to their name, the bank is typically not going to like that because how are you going to buy a house in another country and have $2,000 left to your name? So they want to see some reserves. I mean, it doesn't have to be a lot, but it has to show that they're able to, carry a payment or two if they can't get it rented quick enough or, things happen. All large deposits must be verified. Again, there's no set guideline as to say all deposits over X amount must be verified. It's kind of a common sense, sometimes it's not so common sense, but it's what the underwriter wants of what they want to verify. I mean, if somebody makes $5,000 a month and they have a $40,000 deposit, they're gonna ask to source it. If somebody makes $50,000 a month and they have a $40,000 deposit, they might not ask to. So it's all kind of relative to the financial status and situation of each client as to what large deposits are classified as. In addition to the credit, income, and assets, they typically ask to verify their primary residence. It's going to be in the form of verification of mortgage, verification of rent. If they own the property free and clear, sometimes they'll have a deed, sometimes they don't. You know, some countries, they actually have to physically walk to a courthouse, go through a book, and like take a picture, which, you know, the bank isn't really gonna accept regardless. So for those, usually we'll just get like, you know, the taxes and the insurance to prove the ownership, and that's what the lender will use. We do have sample letters available. We do them in several languages. So whatever language your client speaks, we can send it in that language. They can take that to their bank or creditor and have them do that letter in their language. And then we have the certified translators on our staff that will translate them in order to go to the lender. Okay, so how do my clients get a loan pre-approval? So, like anything else, we like to speak to the clients before you guys take them in your car. Because not all clients understand how the process of getting a loan works. And in some countries, it's as easy as them as walking into a bank and saying, "Hi, I've banked with you for 40 years, I need a loan," and the bank says, "Sure." It doesn't work that way here. And as much as you tell them sometimes, until you get into the process, they don't understand. So, you know, it's showing them the difference between how things are done here in their home country, and letting them know that it is a significant change of what they're used to. So it is better for them to speak to us even before they come to the US, so that way they have a good understanding of what they can buy, what they qualify for, what their payments are gonna be. You know, we can confirm that, you know, they can buy for a certain amount. We have a lot of clients who, you know, a realtor will call us and say, "Oh, my client left this house, they wanna buy 600,000, they told me they have plenty of money," and blah, blah, blah. And then we speak to the client and, yeah, they own, you know, 6 houses free and clear in another country, but they have like $50,000 in the bank account. So, I mean, they can't qualify for what they think they qualify for because they think they have all these assets. It's just in real estate, it's not in liquid assets. So it's important for us to kind of get a good understanding of what they truly can qualify for, you know, to help you too, and not waste your time taking them to see things that they can't afford. Obviously, pre-approvals uses the negotiation with the seller. You know, we do the pre-approvals based off of the income, liability, and assets as the client is stated to us. However, if we think something may not be right, usually we will ask for the documentation. If somebody comes to us and says, "Oh, I'm self-employed and I own like a mechanic garage in Brazil, but I make 100,000 reals a month," even if you convert that, that's a lot of money for a mechanic in Brazil. So, you know, knowing that, we'll say, okay, can you send us like your most recent bank statement and a letter from your CPA? That way we can kind of look at it and make sure that it is what it is and work out the kinks before they enter into a contract.
I have a question.
Yes.
How long does it normally take to get a loan pre-approval?
I mean, the pre-approval usually, we have a form, we call it our inquiry form, that we have the clients fill out. It's kind of like some basic information, just with how much do you make, how much did you make last year, how much is in your accounts, do you own any homes, that kind of thing. I think it's like 3 pages, but it's big spaces. So once we have that back from the client, as long as they complete it fully, we usually do a pre-approval within 24 hours. We can do it quicker. Usually, one of us can be reached after hours if needed. So it's pretty quick as long as the client gives proper information. And like I said, there's not anything to, red flag on there that we have to speak to the clients with more. Again, we do have our inquiry form. It is also on our website. Our website is in, I believe, 6 languages: English, Spanish, Portuguese, German, and Mandarin. And on our website, they can complete the inquiry form right on the website, or they can fill it out on, in a PDF form. So it makes it easy. It's in their language. That way they understand what's on there. Okay, so timeframes. The most frustrating thing on a foreign national loan is the time frame, because the time frame, in essence, is 100% controlled by the client. So foreign national loans are kind of the opposite of doing a conventional loan. Okay, as a U.S. citizen, I go to a bank. I say, okay, here's my income, here's my social, here's a bank statement. Give me a loan. And then it goes into underwriting, and then it comes out, and the underwriter asks for 16 things, and I submit that to the bank. Well, on a foreign national loan, there is no credit to pull, there's, none of that stuff. So the client literally has to go and collect all of these documents, credit reference letters, bank statements, things like that, where generally they have to actually go in somewhere and get these letters, and that takes a lot of time. I mean, sometimes it could take 30 days from the time they ask for a letter to get it. So that's where these time frames kind of fall, is that the foreign national clients have to have all of that up front when they submit it to the bank. Otherwise, the bank doesn't have anything to underwrite. So we try to work with our clients to get everything together in a nice, pretty package before it goes to the lender, so that once it goes through underwriting, it's just approved. There's usually not too much else that they ask for, because we get everything up front. So this is where it kind of gets backwards when you're talking foreign national loans, because they can make loan application within 5 days. However, they're probably not going to get an approval for 30 to 45 days. Not because it takes the bank 30 to 45 days to give an approval, because typically it'll take a week or 2 to get an approval, but it's going to take the clients 10, 15, 20, 30 days to collect all the documents they need in order for the bank to give them a loan approval. So that's why it's really good to set the expectations and write the contracts knowing that these foreign national clients are going to take a little bit longer to get their documents up front. So we generally say that a financing contingency should be 30 to 45 days on foreign national loans. And closing can be 45 days to 60 days, because once we get the approval, it's usually a quick process to the end. The loan process, once everything goes into the bank, it's pretty much, we have 4 to 8 weeks. Some of our lenders do take 8 weeks, but in general, most of the lenders that we use, the majority of the time, they take about 4 weeks. So even though we're saying closing in 45 to 60 days, that's kind of allowing 2, 3, 4 weeks for the clients to get their stuff together, and then the 4 weeks for the bank to process the loan. Loan approvals, they typically last 90 to 120 days. If closings are further out, when you have new construction, things like that, it doesn't mean that they don't have a loan after that 90 or 120 days. They just have to update their documents in order to update their approval. contacting us as early as possible helps in order for us to be able to prepare the client to get the documentation that they require so that the process can move a little bit quicker in order to meet deadlines. So what are the necessary steps to obtain financing? So this is kind of the step-by-step of how the foreign national process works, which is a little bit different than your standard conventional loans. So you have your initial consultation, which is what we do one-on-one with the client. We usually give them several loan options and allow the client to choose what works best for their needs. Once they choose a program, we issue pre-approvals. They then get their purchase contract with their financing contingency. They'll supply us the necessary documents that we're requesting based on the loan that they chose. Once we have all of those documents together, it gets submitted to the lender as a complete file. We then get a conditional loan approval. Usually we get the appraisal after we get the conditional loan approval. Once the conditions are in, the appraisal, the property survey, everything will go in for a final loan approval. We set up the notary appointment or embassy appointment with the clients because most clients don't come for closing. So we try and work it with them to make sure that they understand everything they need. The loan then will become clear to close. A closing package gets sent to the title company. We send the closing documents usually to the clients via email with a very, very detailed step-by-step of how their documents need to be signed. We also go over it with them in their language to make sure that they understand what they're signing, answer any questions they have. They typically go to the embassy or a notary, send us copies of the documents before they put them in FedEx to make sure that everything is done properly. Once we approve it, they put it in FedEx, it comes back, and we have closing. So the process is a pretty smooth process as long as the clients do what they have to do on a foreign national loan. That's the hardest part, is making the clients aware that there's deadlines that they have to follow. Okay, so why use Paul International Consultants? I'll just give you a little bit of information here as to why our services are different than going somewhere else. So we have offices in 2 time zones, which make it very convenient to be able to talk to clients in other countries. We do one-on-one personal consulting in the client's language. Excuse me 1 second. I'm choking. So we do the one-on-one consulting in the client's language, which helps them to be a little bit more comfortable and understand the whole process. We do sample calculations for the clients so that they understand all of the closing costs that are entailed. We help them to select the best program that fits their needs. So we don't just have one program. If you go to a bank, you're talking to a person, they offer one program, that's it. We have several programs available, and depending on the client's needs, depends on which programs we would offer them. We help them to complete the loan application. We help them to collect the documents. We review all of the documents to ensure that they are what is acceptable to the lender. So this is the big part of why a lot of our clients use our services. And we do get a lot of clients who come to us after the fact, and you know, it's a little bit more difficult for them. So what happens is you have a client who goes into the bank and they apply for a loan and they submit documentation, and whether the documentation is correct or not correct or what the bank wants, the bank can never unsee what's given to them. So, you know, for instance, we get clients and they'll have large deposits on their bank statements, which is pretty typical for a lot of people. But if they can't source where those deposits came from, and a lender sees that they have those large deposits, the lender's just going to deny the loan because they can't, you know, they can't source them. When we have clients who come to us, we can prepare them for what is needed in the future. So if we have a client who, let's say, had a $40,000 large deposit, and he says, oh, well, it came from, you know, my cousin because I lent him money, you know, 7 months before. And, you know, we can work with the client to then get the bank statements from 7 months ago, or get a letter in writing from their cousin who, you know, he loaned him money to buy a house, and we can, you know, we can work with the documentation and put it together in a nice little package so that when the underwriter goes through it, it's not just a red flag that there's a $40,000 deposit. Because, you know, a loan officer from a mortgage broker or something can go back to the client and be like, well, you had this $40,000 deposit, what is it from? And the guy's like, oh, well, I lent my cousin money and then he paid me back. But maybe the client doesn't really understand that he has to show all of that information. And then he gets declined, and then he has to start over, and now he's asking for extensions. We have it a lot with clients who maybe had like a personal loan, but then it got paid off. Or, you know, sometimes you get letters from companies that are wrong, and they don't even realize they're wrong, because they're in one language, you have to translate it. Sometimes translations come back wrong. And you send a translation to a bank and the translation itself is wrong, and they deny the loan. And you can't go back and be like, oh, what, the translation said this, but it's really this. The bank just says, no way. So that's why we really look at every document to make sure if there are large deposits, if there are personal loans, we help the clients to give the documentation up front so there's no red flags. We check the translations, we check to make sure all of that is really together so that when an underwriter looks at the file, there's no questions. So doing an analysis of the documents really helps the lender to be able to underwrite and approve the file as efficiently as possible. We do the certified translations. We do double check them to make sure everything is correct. We assist the clients in reviewing all the disclosures, explaining them, going over the rates, making sure they understand all the terms of the mortgage. We speak to our lenders pretty much daily. The ones we work with on a regular basis. So we can give weekly updates. Usually every Friday, our team calls not only the clients, but each of the realtors and make sure that you know what's going on throughout the process. We also help the clients to open U.S. bank accounts if they're needed, whether it's for their loan or just for personal use. We follow up on making sure appraisals get done, that, you know, insurance gets ordered in a timely fashion, things like that. We also coordinate everything like I said before, with the closing, to make sure that, you know, they have an embassy appointment or they're flying here, that they understand if they're going to an embassy, they need 2 witnesses, things like that. So, what are the advantages for financing? We get a lot of clients who come here and they're like, yeah, I'll just pay cash for the property. So, you know, there are advantages for them taking out mortgages depending on the client's financial situation. The first one is being liquid. If a client, you know, has $200,000 and they put $200,000 into a property, and then, you know, their daughter decides that she's getting married the next year and now they don't have the cash to be able to do a wedding for their daughter. We get a lot of these clients because now they're coming back to us to do a cash out refinance because they need the liquidity. So, you know, it also helps with liquidity that if somebody has, you know, a significant amount of money and they want to buy an investment property, if they take out a loan, maybe they could buy 2 properties and make more income than just purchasing the one. Most of the loans have no prepayment penalty. So if a client wants to get a loan, they can get a loan and pay it off when they're ready. Let's say, you know, they have a house in another country, they know they're getting an inheritance down the road. Maybe they have a house here that they're trying to sell, but it hasn't sold yet, and they find their dream house. These are the types of things that help people in order to kind of bridge that time when they don't have the cash themselves. Low currency risk. This is a big thing with Brazil right now. A lot of these clients of ours that we have signed contracts maybe a year or 2 ago for new construction homes. And the real recently dropped significantly. And all these clients who sign contracts and can't get out of them now don't really have the same cash value that they had 12 or 18 months ago. So now they're getting financing. You know, whether the real is going to change or not change in the near future, we don't know. But the good thing about it is they can get a loan. They're renting out those properties. They're getting some sort of income, which is in US dollars, and then they can use the US dollars to then pay off their mortgage. So they're not having to send money on a monthly basis from another country. They can wait and they can send it. Let's say in 6 months from now, the real goes up. They decide they're gonna send, $50,000 or $100,000 towards their mortgage. They send it in one lump sum payment. And then it will go directly towards the principal. And the client doesn't have to worry about sending, the difference in it every single month. And it helps to give it a more stable investment than them having to worry about the currency exchange rates. It also helps with taxes. I guess a little bit less these days than it used to, but when you have a mortgage, you're still able to write off the interest on your tax return. So if somebody is buying an investment property here and renting it out, besides like some maintenance, they don't really have any tax write-offs. So by them having a mortgage, they're going to be able to use that to, pay less taxes. It also helps with a credit history. If you have a client who is buying investment properties here and eventually moves here, well, now they've had years of making a mortgage payment, they get a social security number, they can contact the bank and ask them to put that on their credit report, basically gives them instant credit. The low down payments, although they can be paid off quickly, most payments are based on a 30-year amortization, so the payments are lower. And what's been on here too, credit score, that having mortgage payments will give them a credit score, because it's really hard to get credit cards, car loans, things like that, having no credit. So if they can establish the credit, having a mortgage, it instantly gives them payment history plus a credit score. And then they can use that to get additional credit. So here's just a couple little fun facts, which now are about a year overdue, but they haven't come out with the new reports yet. So, so basically from April of 16 to March